I have been a real estate broker, investor, and fund manager for 30 years. In that time, I have looked at thousands of properties. I have brokered deals in multiple countries and managed funds worth tens of millions. I have seen more people lose their life savings here than anywhere else. Why? Because they fall in love with the property instead of the numbers. They see granite countertops and imagine the perfect life. But real estate investing is not about countertops. It is about math. Cold, hard, unemotional numbers. Without the math, it's a liability. Most new investors get overwhelmed by spreadsheets and cap rates. They spend hours on one deal only to get paralyzed or buy a bad one. Today, I'm showing you how to cut through the noise. I'll teach you the exact framework I use to analyze any rental in 60 seconds or less. This is the same framework I use for my own portfolio and my high net worth clients. It's a simple two-step process to save you time and money. If you're buying your first property or expanding your portfolio, you need this. Let's dive into the math of profitable real estate. Before the formulas, we must address the biggest mistake: emotional investing. A home you live in is one thing, but an investment is business. Your tenants and the bank don't care how you feel about the house. Only one thing matters: income versus expenses. I had a client who loved a beautiful home with a pool and a 3-car garage. He said, "JM, anyone would want to live here." The price was $600,000, but rent was only $3,000. I told him to walk away, but he was emotionally attached. He bought it. 6 months later, repairs and vacancy cost him thousands. He was losing money every single month and had to sell at a loss just to stop the bleeding. He lost money because he bought a house, not an investment. This framework is designed to force you to look at the cold reality of the deal. Step 1 is applying the 1% rule. It's a quick calculation that tells you if a property has the potential for positive cash flow. The 1% rule states that the gross monthly rent of a property must equal or exceed 1% of the total purchase price. For a $200,000 property, it must rent for at least $2,000. If it's $1,500, it fails. If it's $2,200, it passes. Why? Because mortgage is only part of it. Taxes, insurance, and repairs usually take about 50% of your gross income. If you rent for $2,000, expect $1,000 in expenses. That leaves $1,000 to cover your mortgage and still keep some profit. If it passes the 1% rule, there's a high probability of positive cash flow. If it fails, it's mathematically almost impossible to profit. The 1% rule isn't a guarantee, but it's an incredible filter. It saves you from wasting hours on deals that simply won't work. Now I know what you're thinking. JM, I live in LA or New York. There are no 1% properties here. And you're absolutely right. In expensive coastal markets, $1 million house might only rent for $4,000 or $5,000. That's a 0.5% ratio. Investing in your own backyard, there's a gamble on appreciation. You lose money every month hoping the value goes up. I don't speculate. As a professional, I invest for cash flow. I want to get paid every single month, regardless of the market. Cash flow is the foundation. If the numbers don't work in your city, find a city where they do. Invest out of state in markets with job growth and friendly laws. This is what I do for my clients. We identify markets where the 1% rule is achievable and build teams on the ground to handle it all. Do not let geography dictate your strategy. The math is the math. Follow the 1% rule and it will lead you to profitable deals. Once it passes the 1% rule, you need to know how hard your money is working. This brings us to step 2, the rule of 72. The rule of 72 estimates how long it takes for an investment to double. Divide 72 by your expected annual return. At 8%, it takes 9 years. In real estate, we apply this to our cash-on-cash return. That's the ratio of your annual cash flow to the total cash you invested. If you invest $45,000 and get $3,600 back annually, that's an 8% return. In 9 years, you've doubled your money. The power of this rule is setting objective benchmarks. I will not touch a property unless it generates at least a 10% return. Why 10%? Because that means my money doubles in 7.2 years. If a deal takes longer, it's not working hard enough for me. When you analyze a property, establish your own benchmark. What is your minimum acceptable return? 8, 10, 12. Once you have that, the 60-second analysis is simple. Does it meet the 1% rule? Does the return meet your benchmark? If yes, keep going. This process eliminates 95% of properties. It forces you to focus only on the top 5% that actually make sense. But cash flow is just the tip of the iceberg. Real estate is a multi-dimensional asset class that builds wealth in 4 ways. Cash flow is your profit. Principal paydown is your tenant building your equity. Appreciation adds to net worth, and the tax benefits are powerful. Combined, an 8% cash return can actually be a 25% total return. But remember, cash flow is the cake. Everything else is icing. The analysis is only as good as the numbers. If you underestimate expenses or overestimate rent, you're buying a money pit. When I analyze, I use hard data, tax records, insurance quotes, and realistic vacancy rates. Most new investors underestimate maintenance. Roofs break. HVAC systems fail. You must allocate a percentage of your rent to a reserve fund every month. If you don't, you'll pay out of pocket. Always be conservative. Assume slightly lower rent and higher expenses. If the deal still works with those numbers, you have a winner. Many think they'll save money by managing themselves. Trust me, property management is a full-time job. It's not passive if you're doing the work. Professional managers have systems for screening and repairs. They are worth every penny. If a deal only works because you're doing it for free, it's not a deal. The beauty of the 60-second analysis is scalability. You can evaluate dozens of properties in minutes and discard the ones that don't fit. This separates professionals from amateurs. Professionals analyze 100, offer on 10, and buy the one that makes mathematical sense. In a competitive market, speed is a massive advantage. While others build spreadsheets, you run the numbers in your head and make an offer on the spot. A warning on turnkey properties. They're marketed as the ultimate passive investment, but never trust the pro forma provided by the seller. Turnkey providers often inflate rent or ignore capex. Run your own independent 60-second analysis. You are buying the math, not the marketing. The analysis is the first step. You also need a professional network, inspectors, attorneys, and brokers who understand the local market. As a broker, my job is to protect you from bad deals. I look at zoning, trends, and economic indicators to ensure your foundation is solid. Successful investing requires a specific mindset, discipline, patience, and a relentless focus on numbers. You must be able to walk away. With this mindset, real estate stops being a gamble and becomes a predictable process. You stop buying houses and start acquiring assets. Real estate is a get-rich-slow scheme. It's about building generational wealth to fund your retirement and leave a legacy for your children. Every analysis you run impacts your future. A good decision compounds into massive wealth. Master this framework now and you'll be ready. If you're tired of guessing and ready to build a portfolio based on cold, hard math, you need the right team behind you. I'm here to guide you. I've spent 30 years brokering deals and building wealth. I know what a good deal looks like, and I definitely know a bad one. If you want to invest in Florida with a broker who thinks like an investor, click the link below to book a consultation with my brokerage. We'll sit down and build a strategy based on the math. We'll find the deals that satisfy the rules and generate the cash flow you need. Stop falling in love with countertops. Start falling in love with cash flow. I'm JM. Thank you for watching, and I will see you in the next video.